Hello and welcome to the Stock Out. The Stock Out is your show at FreightWaves for all things related to the consumer packaged goods industry, the CPG industry, which makes up about 1/5 of all freight transportation spending. I'm your host, Mike Baudendistel. I'm the head of intermodal solutions here at FreightWaves, and this is a show we set aside about 26 minutes every week to talk about, what I think is relevant, what I would want to know if I was a logistics manager at a CPG company. And so what I have for you today is I'm going to talk about Walmart's results and specifically how I think those results relate to CPG companies, what CPG companies should take away from those results. Next, I'll go through the CPG sessions at last week's FreightWaves Global Supply Chain Week. I'll just give it a little bit of an overview and for more detail, direct you to tv.freightwaves.com. Those are all up on that site. And then finally, I'll go through the latest in the investigation of the derailment in East Palestine, Ohio, talk a little bit about what regulations might change as a result of that. There always seems to be a lot happening in the rail industry these days, including yesterday, the news that Lance Fritz, the CEO of Union Pacific, will be stepping down, potentially to make way for Jim Vena, who seems to be the hedge funds preferred CEO. So I can talk about those things. And first, if anyone has not already signed up for the CPG newsletter, would invite you to do that. All you have to do is go to www.freightwaves.com/the stock out, or just go to freightwaves.com. It's up there under newsletters. The first one under supply chains, right in the middle, as you can see on the screen. Aim to send that out every Wednesday at about 2:00 Eastern time. When really have sort of discretion to write about whatever I feel like writing about. Hopefully it touches your business in some way. So with that, I'll get into the top story today, which is talk a little bit about Walmart's results last week. I'm not going to talk about this the way that a financial analyst would, but really from the perspective of a CPG company. So CPG companies want to know everything that Walmart's doing, because Walmart, for a lot of CPG companies, for most of the big ones at least, represents about a 20% customer. Some of them, it's more than a 20% customer. And in most cases, Walmart is the only customer that represents more than 10% of their sales, although that's going to change for some of them, assuming that Kroger is able to buy Albertsons and it's not blocked by the Federal Trade Commission. So but in any event, I think Walmart is going to be taking share in grocery, in CPG, because they do seem to be making a fair amount of headway with consumers that are relatively high income, consumers that are going into Walmart versus a traditional grocer in order to take advantage of those better priced grocery items. And then while they're there, they mentioned there's a high attach rate for other types of consumable items, so things like personal care products, paper towels, things of that nature. So they're doing well there. You can see from this the stock chart on Walmart that shows it's outperformed the last few years, and that goes into what they talked about as far as the consumer. And Walmart's statement on the consumer is really guided to a lot of caution, and so their sales outlook for their fiscal 24, which roughly almost corresponds to calendar 2023, off by a month as retailers typically are. Their outlook is for overall sales between 2.5% and 3%. That includes 2 to 2.5% U.S. same-store sales growth. What's typical in far as their longer-term outlook is 4% revenue growth, and the past 5 years they've had 6% compounded annual, revenue growth. That's why the company's outperformed the S&P. I think we have a stock chart on that we can show. But basically, it showed companies outperformed the S&P, grown a little bit faster. They seem to be making headway, with things like making the shopping convenience more seamless. You can go in a lot of cases, just scan the item on your phone. Don't have to wait in line or wait for a cashier or wait for a self-checkout thing that never works. So they've been doing better with that. But if I'm a CPG company, look at some of those results and saying, okay, well, Walmart is sandpapering down what it typically expects in terms of sales growth. Not a good look for the consumer, particularly given that there's a lot of natural hedges in place. with Walmart that when consumers are in more of a tighter budget, seeing inflation and other things, that they'll go to Walmart for value. So, I think if it didn't have that advantage, it would be a steeper decline in the sales outlook. I'm expecting something of more of a significant sales cut when Target reports earnings tomorrow. The last few quarters, it's been kind of an exercise in seeing how much better Walmart has been performing relative to Target. Another interesting thing that came out of this was, Walmart on the consumer, they tend to look at, a number of things, on the consumer. That's not just, their sales that they see, on a constant basis, but they pointed to uptick in auto loan delinquencies as one of the concerning metrics for consumers. And so some of the stats on this, I think, are kind of interesting. So 1.84% of auto loans are now 60 days or more past due. That's 27% higher than a year ago. And this is particularly hitting the younger, demographics. The 90-day delinquencies for people between 18 and 29 at a 5-year high. For millennials, it's the highest since 2019. And auto loan debt is now at the highest level it's been in over 20 years. Of course, part of that's because the auto prices have been very high, and the average monthly payment on auto is now over $700 a month. And here's another interesting stat. Over 50% of Gen Zs say their car payment has caused them to go more than 30 days late on another type of monthly debt. 33% of millennials said the same thing. So Walmart is looking at that statistic and saying, well, okay, this is going to cause lower sales, maybe offset partially by more trading down and growth in their private label brands. As far as the CPG's interest on pricing versus Walmart's interest in pricing, my view on that is that this is going to be a more difficult year for CPG companies to raise prices on the retailers. Most of the big CPG companies have gone through multiple rounds of raising prices, 3, 4, 5 rounds in some cases, whereas what's more typical is maybe, one a year or so. There was a good quote in Reuters from Edgewell Personal Care's CEO, and that's the owner of Schick Razor, among other personal care brands, and they said it's going to be very hard for CPG companies to raise prices further from here. That may pertain a little bit more to the personal care side of things. As far as food, I think it's a positive for CPGs that Walmart acknowledges that there's still high inflation in food, where they say that the inflation there is still up, kind of mid-teens. If you look at that food producer price index, that was up in January about 9% year over year. So really, I think, Walmart's at least acknowledging that some of the food inflation is there. They do draw the distinction between dry food, which is a lot of that consumer packaged goods, and the other types of food, which would be things like meat and milk. And in those cases, there is some drop in prices in the past year. But for CPG specifically, really a lot of these prices are a 20% increase in price on a 2-year stack. So they talk about how even though some of the year-over-year comps are going to look a little bit better, maybe they're only up 5%. You do have to keep in mind they were up 15% or so the year before in 2022, in some cases close to 10% the year before that. So really a lot of inflation there, which seems to be helping a lot of these companies' private label brands. Walmart talked about its private label brands having a market share gain of about 160 basis points, which I think as if there is more of a contentious relationship between the CPGs and the retailers this year, the retailers are going to promote those private label brands even a little bit heavier. Another takeaway from Walmart is, Walmart expects its gross margin to increase this year. So, one of the ways they could do that would be, of course, holding the line on the prices from its suppliers. But they also talked about something that goes in there is lower supply chain costs, which, might include lower transportation costs. But in general, they don't seem to think that there are lingering supply chain issues, whereas the CPG companies, to a large extent, have said, well, the supply chain issues are less than they were, but there are still some lingering issues where trucks not getting the right inputs at the right period of time. So there were times when Kraft Heinz in the past couple quarters said that at any point in time they either don't have some ingredient that they need, or they don't have some type of packaging material that they need. But Walmart seems to think those days are behind us. That makes me think that maybe Walmart is going to be more strict with its CPGs in terms of enforcing on time and in full type of rules. Could be greater penalties placed on CPGs for that reason. And then I'll leave you with one final takeaway, is that which relates to transportation, is that Walmart, at least for the most part, seems to think that its inventories are under control. It says it's not too far from where it was a year ago, and really they got rid of a lot of that excess inventory. I think they said it was within 3% of where it was this time last year, and you do have to keep in mind the inflation in that number. So it's really kind of lower on a unit basis, and they say really sort of the lingering area where there's an oversupply of inventory would be on apparel. So people have apparently stopped buying clothes, which makes sense to me. But nothing there suggests that, kind of the bullish indicator for freight transportation that I think a lot of the carriers are looking for is at some point the inventory levels will be drawn down to a point where those inventories need to be restocked, and that would create a lot of freight transportation demand. Not seeing it yet in our data at FreightWaves, and not seeing evidence that that is upon us from these retailer results. So I'll move on from Walmart and talk through some takeaways from last week's Global Supply Chain Week. And invite anyone to go to tv.freightwaves.com, check out those clips. There's a lot of them from the 3-day conference. I can go through a few of them here. One of them is from our friend Ben Ritchie at Black Rifle Coffee, who I interviewed for this show a few weeks ago. He says U.S. consumers are getting very specific on what they're going to reach for on the shelf. So, not that consumers have stopped spending money. They haven't. They're just being a little bit more selective. They are seeing some trading down in the market in general, but doesn't think it's impacting Black Rifle too much. They seem to have a good brand that is growing quickly. So that seems to be blunting a lot of that impact that might otherwise been seen from trading down. They also are looking at private or dedicated fleets and leveraging our data and other data in the marketplace to see when is a good time for that. And so kind of the idea is to lock in freight rates for dedicated capacity, which, those rates tend to be a little bit, stickier than the traditional sort of contract rates, which don't have a lot of teeth. When contracts, when the rates, maybe are somewhat closer to a bottom is when you want to establish those contracts as a shipper. And that sentiment relates closely to the Chart of the Week article that my colleague Zach Strickland wrote up over the weekend, which says truckload capacity has 25% too much capacity. So Zach, is estimating that it's about 25% too much capacity, based on a lot of the data that we have in Sonar. And one data set in specifically is the contract load accepted volume Sonar chart, which we're comparing the number of loads accepted, sort of accepted tenders today versus the accepted tenders when there was the most recent spike up, which is took place in September. So this is a chart that sort of gets to that last point of when Black Rifle Coffee or any other CPG shipper might want to enter into a dedicated contract. And ideally, you wouldn't do it when rates are peaking, more when they're kind of troughing. And that chart specifically sort of suggests that van contracts have further to fall, given that the spot rates, which the spot rates are in orange there, with an algorithm that backs out what the impact of fuel is. Let's call that about 66 cents. Spot rates are about 66 cents below van contract rates. So that does suggest van contract rates have further to fall. But the trajectory of those contract rates falling does not seem to be as steep as you might have expected. I think when you sort of look at that data point, you maybe would have expected those rates to come down further, but they are coming down slowly but surely. So I think if I'm a shipper, I might drag my feet just a little while longer in hopes that the freight rates might loosen up just a little bit, and then try to enter into a dedicated contract. So those are the type of things that shippers use our data for. Another session in the Global Supply Chain Week that pertains specifically to CPG was from Tom Madrecki, was interviewed by my colleague John Gallagher. And so Tom Madrecki is a VP of Supply Chain for the Consumer Brands Association. So the CBA is a trade group that works on behalf of branded companies, both inside of food, outside of food. And they talk about how there's really this need for progress to improve supply chains. He talks about the shortage of commercial truck drivers. Nothing has been done to make their life any easier. Even just increasing how much parking there is would dramatically improve the commercial truck driver experience and maybe make it a little bit easier to find drivers. He also had a lot to say about the declining railroad performance, something that seems to be kind of almost a constant theme in terms of rail service. Even today, the hedge fund that wanted Union Pacific CEO Lance Fritz out cited the railroad service issues, and we're going to be talking about more about this on Thursday on the People Speaking Rail show. But Tom Madrecki at the Consumer Brands Association talks about poor rail service. He also talks about how there's no body of government that coordinates the many moving parts of the nation's supply chain. That you have basically the issue is you have a lot of local governments and companies that are kind of working in their own interest, just looking at their one little silo, and don't consider the fact that, let's say, really what drives a lot of the congestion in the North American transportation network is a lot of these highway interchanges that really need to be de-bottlenecked. So the Consumer Brands Association is an advocate of having a nationwide supply chain program that would help CPG companies get their components throughout the supply chain. Another session from Global Supply Chain Week that pertains to CPG and specifically food and beverage companies was the session that I did with Herman Hackstein. Herman is the founder and president of the Private Railcar Food and Beverage Association. He founded that organization after his time as CEO of FHW Group. That's a company that was the largest lessor of refrigerated rail cars. So he really had some interesting things to say, specifically on the East Palestine derailment. Initially it seemed like there was some oddity with the wayside detectors, where the detectors really should have caught the rail car axle that was heating up, and that's really it appeared that was the issue before this latest report that came out. But anyway, getting back to Herman Hackstein and the president and the Food and Beverage Association, they want better statistics for rail service, not speed and terminal dwell. He says those are not helpful. Want something more like first mile and last mile data as it pertains to rail movements, because that would really help improve service. On the rail car side, he expects tightness in box cars to continue. About 50% of box cars are nearing the end of their 50-year life. So a lot of those really are ancient, sort of after 50 years, doesn't matter what state rail car is in, needs to be retired. And we're only going to replace about 30% of that retiring fleet. So some of the shippers out there that use railroads and use box cars specifically may have to use intermodal containers as a substitute for box cars. And then when you ask Herman, sort of in which cases should a supply chain manager use railroad, versus truck, and he says it really has a lot to do with how you're managing inventory levels. Are you going to have kind of a just-in-time inventory, in which case you probably just need to use the highway and only the highway? If you have forward inventory, and going to look at the buffer stocks, then you can think about adding railroad into your supply chain. But that does add another layer of complexity there. And really, it's sort of critical that you select sites that have modal options, and ideally, different railroad, options, because you can't count on railroads to quote you a fair rate. You can't count on the action in DC for reciprocal switching, those types of things. But I'll move on from Global Supply Chain Week to talk about the last topic here, which is the NTSB, the National Transportation Safety Board, last Thursday issued a preliminary report that focuses on overheated wheel bearing. This is an article you're seeing on the screen that Joanna Marsh just wrote up on some of the reactions to that report. So this was just a fact-based report for now. The full investigation is going to take anywhere from 12 to 24 months. And of course, that frustrates people. Why does it take so long? But they're really going to focus on a lot of different things. And so the sort of the list of things that the investigation is going to focus on: the wheel set and bearing that overheated. So that's kind of the obvious thing. They're going to look at the tank car design and derailment damage. Now, it wasn't a tank car that caused this derailment, but it is a critical issue as to the crash worthiness of tank cars, because this wouldn't have been an issue if the chemicals would have stayed in the tank cars. You go back a few years, the tank cars had to be retrofitted with head shields to prevent puncturing. So they're going to look at some of the valves there, and there were some DOT 111 cars on that consist. Those can only be used for certain materials, not for others. Some have to use the tank cars that have the what are called DOT 117 cars, which have additional safety features. So they're going to look at that. They're going to review the accident response, which NTSB is quick to point out was not their call to have the venting and burning of the vinyl chloride, and that's really why it was such national news. Is there were big pictures of black smoke. I don't think it would have been such a red ball case if it wasn't for those pictures that made the rounds on social media. So they can look at that response of whether that really was the right thing to do. They're going to look at rail car design and maintenance procedures. Really that car that caused a derailment, which I think they call car 23, which was actually a plastic pellet car. Was there something about that rail car that was not properly maintained, or was there a manufacturing defect, something that should have been caught? They're going to look at all of those things. They are also going to look at Norfolk Southern's use of wayside defect detectors, and it's not clear yet whether any of those detectors did anything wrong. It kind of seemed like there was nothing wrong with the detectors based on that preliminary report. They're also going to look at Norfolk Southern's rail car inspection policies. And then there was a press release, a press conference that accompanied the report. And I thought there were a couple of interesting things there. They said that the different railroads have different thresholds for their hotbox detectors as far as when they deem a rail bearing is too hot and needs to come out of the railroad consist. So this rail car in question, the plastic pellet car number 23, passed through 3 detectors. So it passed through a detector 38 degrees above ambient, and this was, let's say, 30 miles from ground zero. It passed another one 103 degrees above ambient, 20 miles away from ground zero. So it went from 38 to 103 in the course of just 10 miles, which my understanding is that is very unusual. And then within the final 20 miles, went from 103 degrees above ambient to 253 degrees above ambient and being on fire. At that point, the crew is notified. Emergency brakes are applied. The crew applies their brakes as well. And I guess the preliminary report is that the crew members did nothing wrong, which is good to hear. Also, the track, nothing wrong with the track, at least as far as we know now. And so that those numbers I just rattled off, 38, 103, and 253 degrees above ambient temperature, Norfolk Southern standards is between 170 and 200, you stop and inspect, and over 200 is considered critical. So it went from being this wheel bearing is not an issue according to Norfolk Southern standards to all of a sudden being a critical and needs to stop. And it did that in the course of somewhere less than 20 miles, which, getting back to the Herman Hackstein discussion, he says that is very unusual. It'll be interesting to see, as that investigation takes place, what exactly caused that rail car to heat up to the extent that it did. As far as, I can only speculate as to what types of regulations will arise because of this. Maybe those detectors will become more frequent. Maybe there'll be higher standards on either the wheel bearings, or the maintenance schedules might be higher. There might even be more standards on tank cars, for the crashworthiness, even though a tank car wasn't responsible for that derailment. So there's a lot to unpack there, and be sure to write that up. And for anyone interested in rail, I encourage you to view our show, People Speaking Rail, which is going to be on this Thursday at 3 p.m. Eastern. Have a special guest, Dan Elliott, who was the former chairman of the Surface Transportation Board, and he is now an attorney who works on behalf of shippers. And I think CPG companies that move by rail in particular are going to be the ones that would like to listen to that show. So that's really what I wanted to go over today, and hope everyone has a good one.